What if everything you thought about retiring early with dividend income was wrong? I used to believe the same thing. I had the spreadsheets, the plan, the timeline, all neat and color-coded. Dividends at 4%, a $500,000 saved, and I was already dreaming about sipping coffee in a cabin somewhere while checks rolled in every month. It felt like the ultimate freedom plan. No boss, no stress, just passive income while I sleep. But then something happened. I ran one simple calculation. One number, one truth, that completely shattered the dream. It wasn't dramatic. It wasn't emotional. It was just math. And suddenly that feeling of confidence? Gone. Here's the truth. Most of what you hear online about living off dividends is built on a dangerous assumption. One that could quietly cost you your financial future if you don't catch it in time. Today, I'm not just showing you the number that changed everything for me. I'm showing you what actually works. The ETFs that performed this year, the smarter way to retire, and the brutal difference between what sounds good and what works. If you're building a future on dividend income, or thinking about it, you need to hear this. Because this isn't about pessimism. This is about making sure your dreams don't die at the hands of bad math. Let's go there. Together. Why dividends feel like the ultimate freedom plan. There's a reason so many people fall in love with dividend investing. It feels safe, it feels smart. And honestly, it feels like a cheat code. You're not flipping stocks. You're not chasing hype. You're buying into companies with decades of history at Damaya, and they're paying you to hold them. Imagine this. The market crashes 30%. Everyone's panicking, headlines are screaming, and your portfolio's bleeding. But you're still getting paid. That little dividend hits your account like clockwork. And suddenly, the chaos feels manageable. That's what makes dividend income so seductive. It gives you psychological stability in a world of financial uncertainty. It's not just theory either. Johnson & Johnson has paid a dividend for over 60 straight years, through recessions, wars, pandemics. Coca-Cola, same story. It's why they call them dividend kings. And when you own them, you feel like you've joined royalty. Even Warren Buffett, like the GOAT of investing, owns over $25 billion worth of Coca-Cola stock. That alone pays him over $74 million a year in dividends. And he hasn't sold a single share since 1988. That's the dream, right? Buy once, hold forever, and let the money roll in. Passive income, peace of mind, and the freedom to live life on your terms. It sounds bulletproof. It sounds like the perfect plan, but just because something feels safe doesn't mean it is. And that's where the dream starts to crack. Here's the math no one wants to talk about. Here's where the dream runs headfirst into reality. And reality doesn't care how good your spreadsheet looks. Let's say you want $100,000 a year in dividend income to retire comfortably. Seems reasonable, right? Now let's plug in a realistic dividend yield. Not 8% or 10% from risky plays. I mean a sustainable yield from reliable blue-chip ETFs or dividend aristocrats, around 3%. To generate $100,000 annually at a 3% yield, you'd need $3.3 million invested. Let that number sink in. $3.3 million. And yet, all over YouTube, you'll see creators with $500,000 portfolios talking about living off dividends like it's no big deal. I'm not here to judge, but I am here to check the math. Because if you're banking on retiring off a 4% yield from a $500,000 portfolio, you're looking at $20,000 a year. That's $1,666 a month. And after taxes, even less. That's not financial freedom. That's grocery money in a high cost of living city. The real danger isn't that dividend investing doesn't work, it's that we overestimate what it can do alone. And we build entire retirement plans on a number that never adds up. Why your dividend isn't as safe as you think, even if you hit the numbers. The story doesn't end there. Because dividends, as steady as they feel, aren't guaranteed. March 2020 was a wake-up call. Disney, a global icon, suspended its dividend entirely. Shell, like one of the largest energy giants, cut its dividend for the first time since World War II. Even dividend aristocrats with 25-plus years of increases started folding under pressure. That reliable check you thought you could count on? Gone. overnight. And here's where most investors go from smart to desperate. They start chasing yield. They find an ETF paying 8%, 10%, even 12% and think, this is it. This is the shortcut. But those super yield funds often come with hidden risks. Volatile holdings, poor fundamentals, or deeply cyclical sectors. You're not buying safety, you're buying stress. Let's not forget about REITs either. Sure, they legally have to pay out 90% of income as dividends. Sounds great, until the Fed raises interest rates. REITs are highly rate sensitive, and when rates jump, your share price can drop 25 to 30%, wiping out years of income in a single downturn. And then there's taxes. Some of those juicy yields aren't qualified dividends. They're taxed as ordinary income, which means your 4% could really be 2.7% after taxes. Surprise! This is where the peace of mind you thought you bought turns into the anxiety you didn't see coming, because yield looks great until you realize what you gave up to get it. What the top ETFs actually returned this year. So if chasing yield doesn't work, what does? Let's cut through the noise and look at real data. Because this year, several dividend-focused ETFs didn't just pay you, they grew your money significantly. Take SCHD, the Schwab U.S. Dividend Equity ETF. Current yield? Around 3.4%. Year-to-date return? 27.95%. That's not a typo. That's a blend of consistent dividends and strong capital appreciation. Exactly what smart investors are really after. Now look at VIG, Vanguard Dividend Appreciation, ETF, lower yield, 1.73%. Year-to-date return? 24.19%. Why does it work? Because VIG isn't just about paying today. It invests in companies that increase dividends every single year. It's about dividend growth, not just yield. Same with DGRO, iShares Dividend Growth ETF. Yield, 2.13%. YTD return, 25.34%. These are the companies still in their prime. Microsoft, Apple, JP Morgan, not just paying, but scaling dividends over time. Now check VM, Vanguard High Dividend Yield, ETF. Yield, 2.58%. Year-to-date return, 28.16%. Massive diversification across over 400 holdings. When one sector stumbles, another picks up the slack. Minimum drama, maximum coverage. And then there's HDV, iShares Core High Dividend ETFs. Yield, 3.18%. Year-to-date return, 25.51%. This one leans heavily on energy and healthcare. And when oil rallied this year, HDV rallied with it. So what do all of these have in common? They're not the highest yielders on paper, but they performed because they're balanced, disciplined, and built on strong fundamentals. This is the moment when dividend investing stops being a dream and starts becoming a strategy. The Dividend Pyramid, a smarter way to retire. Let's build something smarter, something real. Not a fantasy based on 10% yield promises, but a layered plan built to actually work. Imagine a pyramid, and each layer has a job. Layer 1, income stability, 40%. This is your foundation. ETFs like SCHD and VM, solid yields, low volatility, consistent performance. These are your monthly checks and peace of mind. Layer 2, dividend growth, 30%. Here's your inflation beater. Think VIG and DGRO. Lower yield now, but growing every year. This layer builds your future income, not just your present. Layer 3, capital growth, 20%. This is where you let growth-focused stocks do the heavy lifting. Yes, even if they don't pay dividends. Companies like Nvidia have outperformed everything this year. Without this layer, your portfolio might survive, but it won't accelerate. Layer 4, cash and bonds, 10%. This is your cushion. Emergency fund, flexibility, optionality in market downturns. It's not sexy, but it's what keeps the plan alive when life hits hard. Together, this pyramid shifts you from yield chaser to strategy builder. And it's not theoretical. Run the numbers on this structure with a $500,000 portfolio, and you'll see a better mix of income, growth, and security than any single high-yield ETF can offer. This is how you stop chasing the myth and start building real financial independence. Dividends don't fail. Expectations do. Here's the truth that changed everything for me. Dividends aren't broken. Our expectations are. Too many investors treat dividends like a magic solution, like they'll solve everything, provide income, preserve capital, beat inflation, and replace a paycheck forever, all at once. But dividends were never meant to do everything. They're just one tool. and powerful when used the right way. You know who gets this? Institutional investors. Let's look at how the smart money plays the game. Nancy Pelosi's portfolio? Recent moves into Microsoft and Nvidia, two companies that barely pay dividends. She's not chasing yield, she's chasing growth. BlackRock, one of the largest asset managers in the world, recently increased its holdings in SCHD, not because it yields 10%, but because it delivers consistent performance with quality companies. And of course, Warren Buffett. He loves receiving dividends, but Berkshire Hathaway, his own company, it pays zero. Buffett reinvests and compounds internally because sometimes the best way to grow wealth is to keep the capital working harder, not handing it out. So here's the fork in the road. You can chase the highest number on paper, or you can study what the smartest investors in the world are actually doing. Because dividend investing isn't about finding the perfect payout. It's about building a system, one where dividends play their part alongside growth, tax efficiency, and risk control. Keep chasing fantasy, or start building smart. At this point, you know what the real story is. Dividend income sounds like a dream until you run the numbers, check the risks, and face the reality of what it truly takes to retire early on passive income alone. But that doesn't mean the dream is dead. It means it's time to upgrade the plan. You don't need $3.3 million to build financial independence. You need the right strategy, the right layers, and the right expectations. The dividend pyramid I showed you today, that's how you stop gambling on yield and start building wealth intelligently. So here's the question. Which part of the pyramid are you missing? Drop it in the comments. I read everyone. And if you found value in seeing actual performance data, real-world examples, and clear frameworks, subscribe. This channel isn't about fantasy. It's about building financial freedom with clarity, consistency, and confidence. I'm Mark. This is Dividend Hustle, and I'll see you in the next one. Because now, you know, dividends don't work alone, but when used right, they work brilliantly.